Hey everybody, welcome back to Accounting 1101, where we are kicking off a brand new unit. In our video today, we're going to be talking about retail merchandise business and how to account for it when we buy inventory and when we sell inventory. And then later on, a few videos down the road, we're going to talk about how to value all that good inventory. So we're really all about inventory and accounting for it in our series of videos that we have coming up. We're going to kick it off comparing what we've talked about before to the new businesses that we're going to be talking about in our current series. So let's start that off right now. Where we've been studying the accounting foundation, as I like to call it, that accounting cycle, where we get transactions, we analyze them, we journalize them, we post them to the ledger accounts, we make that trial balance, we make adjusting entries, we make another trial balance, and then we make our financial statements, we make our closing entries, and then you guessed it, we make a final trial balance. 9 or 10 steps in that accounting foundation of the accounting cycle. And we used a business that we called a service business to kind of give an example of the accounting cycle. In our example, it was a web programming business, but you've probably encountered other types of businesses of that nature, consulting, lawn care, maybe you've been to a salon. All of those would be examples of businesses that provide a service and not really a physical, tangible product. And so when we think about the operating cycle of a business like that, usually they get cash, they start up the business, they go out, they find customers and clients, they provide whatever service they're trying to provide, they send a bill, they collect payment, and then they do it all over and over and over again. All right? And we demonstrated the accounting for that. And give you a real world example right here. Southwest Airlines, you're now free to move about the country. Perfect example of a service business. They're selling a customer a ticket to take them from point A to point B, maybe a bag or two as well, and they're not really selling a tangible product. Here they'll throw a bag of pretzels at you during the flight or give you a can of ginger ale, whatever the case might be, but that's really not the main thing they're in business to do, okay? They're in business to sell people a ticket to go from point A to point B. And if we look at the income statement, the financial statements of Southwest Airlines, we notice that they look really a lot like the ones that we've been doing in class. I've got the income statement for Southwest Airlines up here. And you can see they've got their revenues grouped together at the top. There's our ticket sales, passenger tickets, freight, which is probably baggage and any other kind of charges for carrying freight around. And then other. Maybe they're charging people for in-flight movies, Wi-Fi, that little bag of Kahlua that people buy when they get on the plane. So that's kind of how we've seen revenue in our financial statements, right? We have our revenues, then we have expenses, all grouped together underneath that. And you look at the expenses right here, operating expenses, salaries, wages, benefits, payroll, fuel, maintenance, landing fees, depreciation. All that stuff has to do with the day-to-day activities of running Southwest Airlines. And then we got another group of expenses right here. You'll notice those don't really have a lot to do with the day-to-day operations. They really have to do with how Southwest finances operations. We've got interest. We've got loss on extinguishment of debt, which is another interest deal. And then we've got taxes separated still. But at the end of the day, very similar to what we've worked on in class up to now. We've got revenue, we got expenses, and we got net income. The good old income statement. And boy, we talked about COVID pandemic a few times in here and the effect it had on companies in 2020. Look at that. $3 billion net loss for Southwest Airlines in 2020. Recovered a little bit in 21 and 22 there. So big losses there in 2020. We go to the balance sheet. Look at that balance sheet. We've got current assets. We've got property, plant, and equipment. And then we've got total assets down there on the bottom. What you will not see on that financial statement is merchandise inventory. It has inventory, but that's not inventory they are selling to a customer. It's that supplies inventory. Remember we made that supplies entry and supplies adjustment in unit number 1? That's our supplies asset account. Supply inventory, parts and supplies. All right. Not selling it to a customer. I can't walk up to the ticket window at Southwest Airlines and ask if I can buy a case of blue shop towels. All right. They are going to use those in the business, not really selling them. So that's where we've been. Let's talk about where we're going. Still doing the accounting cycle. All right. Everything that you have learned up to this point, it still applies. And so keep all that stuff in mind, the accounting equation, the steps in the accounting cycle, the rules for debit and credit. Don't you dare throw them away because you still need them. Still during the accounting cycle, we're still using that good, solid accounting foundation that we built over the first couple of weeks. But now we're going to apply it to a retail business. Retail business is a business who buys a product and resells it at a markup. And you can think of every store you've ever been in. Best Buy, Kroger, Walmart, Target, Dick's Sporting Goods, Bed Bath & Beyond. Any of them. It's all the same idea. They're buying a product either from the manufacturer or a wholesaler. They're marking up that price and they're putting it out on the shelf. When we look at it from a standpoint of the operating cycle, you'll notice another step in here. We begin with cash. We buy merchandise. The merchandise arrives, we sell it. Sometimes the customer pays in cash. Sometimes we sell it on account. If we sell it on account, we collect money. If we don't sell on account, we collect the money anyway when the customer buys it, right? And then we get back to the cash. And we just do that over and over and over again. So operating cycle, very similar, only now we've jammed in the process of buying and receiving merchandise. And then we sell the merchandise. So our goals here, we need to understand the difference between the financial statements of a retail business and a service business because there are some key differences between the two. We need to understand how to account for buying inventory. We need to understand how to account for selling inventory. Those are two pretty important points, obviously, if we're going to talk about accounting for a business like a Walmart or a Target. So we're going to cover those in separate videos. I'll have a separate video for buying the inventory and the accounting behind that. I'll have a separate video for selling the inventory. And if that doesn't get you excited in anticipation, I don't know what will. All right, so real world. Let's take Lowe's, for example. I was in Lowe's in January, and I took the photo here. It's always interesting to me to see the big box stores when they put out their holiday displays, their holiday merchandise. And there's always that period after December, after the holidays, Christmas season is over, where it's kind of like an identity crisis. They don't know what to put out. And here's a great example. Holiday season's over. Throw the toilets out there right in front of the store. You can still see Santa Claus in the background. So I don't know what it was about January of last year that made retailers decide to put toilets out. I don't know if it was just a bad season or what. Usually they put out the plastic storage tubs, so all these people who bought a bunch of stuff at Christmas can put it in tubs and put it in their garage, right? But they put toilets out there. So, retail business, buying a product, marking it up, selling it. Let's take a look at the financial statements for Lowe's and kind of point out a few differences here. Think back to Southwest. Now we're looking at Lowe's. We have an income statement, and then right off the bat, I bet you that you can pick out something you haven't seen before. Now look up at the top. We have a line item called cost of sales. You'll see that called cost of sales. You'll see it called cost of goods sold. It's an expense account. It goes on the income statement, it's expense account. It shows how much the company has paid to either make, if they're talking about a manufacturer, or buy the inventory that was sold during the period. So at Lowe's, you see 64 billion. Again, the number's in millions, 64.8 billion. That means that basically Lowe's paid 64.8 billion to buy and acquire the goods that they ended up selling. They sold $97 billion worth of goods net, which means that number has returns and allowances subtracted out of it. Stuff people brought back is subtracted out of that number until we get $97 billion in net sales. They paid $64 billion for that inventory that was sold. which gives us the number below, gross margin. You'll see gross margin, you'll see gross profit. Means the exact same thing. It is not an account. Let me emphasize that. Gross margin, gross profit is not an account. I can't book an accounting entry to gross profit. It's a calculation, gang. And what it is calculating is the amount of sales minus what was paid for the inventory that was sold. Gross margin is the product we made just by selling the product. Did I say product made? I meant profit made. I'm going to have to do some editing on that. The profit made just by selling the product. So that number is hugely important for a retailer because that number, that profit right there, has to cover all the other expenses. You see selling, general, and administrative. That's marketing, management, and accounting, depreciation, interest, taxes, and still have some profit left over in net income. So that number is really important. We have to be able, whether we're making goods or reselling goods, to sell them for high enough price that we can cover all the other expenses that we have and still make money. So gross profit, gross margin, especially for a manufacturer or retailer, is hugely important. People really, really look at that number. That's the income statement difference. On a retailer or a manufacturer, you're going to see cost of sales, you're going to see gross margin or gross profit. All right, let's go to the balance sheet. Notice anything different about the balance sheet from what you saw in Southwest Airlines? Yeah, we got merchandise inventory. We have a separate line for specifically the merchandise inventory that Lowe's has bought and hasn't sold yet. It's an asset. Notice it is under current assets. The idea behind current assets are we are going to liquidate those or spend them within a year. So merchandise inventory fits that, right? We'd hope that we sell our inventory balance within a year, that we don't have products sitting there for years on end, right? So look at the number there, $18.5 billion. Nearly half of all of their total assets at Lowe's are merchandise inventory. Lots of inventory. All right. So to summarize all that, put it all back together. A retail business, when we look at those financial statements on the balance sheet, we see that inventory on the balance sheet under current assets, and on the income statement, we see that cost of goods sold, and we see that gross margin or gross profit line. On the service side, we see the balance sheet. There's no merchandise inventory, and there's also no cost of goods sold, because they don't have any goods to sell. They're selling a plane ticket. They're selling a movie ticket. They're selling a shampoo and cut, whatever the case might be. And so I know what you're thinking. You're probably sitting there watching this and saying, wait a second, Professor Martin, you're using the salon example. Now, I've been to the Great Cuts there by Walmart. That's where I get what's left of my haircut. And so I'm with you. And you've been to that Great Cuts and you're sitting there and they're cutting your hair and you look to the front. And what do they have? They've got some old-fashioned magazines, and a little tub of suckers you can get, but they also, more importantly, have some inventory, don't they? They've got shampoo bottles, they've got different hair gels, and different things that you can buy on your way out the door. And I'm sure they priced them at a fabulous markup. All right? And so what happens if it's both? If it's a retail and a service business? I've got a great example for you. Amazon. You probably shopped at Amazon, right? Amazon, as you know, you can get on Amazon.com and buy essential products like what we have right here, important necessities, and have them delivered to your door. You can buy the product, anything you can think of, at Amazon.com. But did you know Amazon also runs a big cloud computing business? Amazon Web Services. They have a tech business going on. And I'm not just talking about like Amazon Prime or streaming music or streaming movies. I'm talking about literally a lot of the traffic that gets routed over the World Wide Web goes through an Amazon web server. All right, so they got a huge service business where they're selling computing, consulting, and storage and server space and all that stuff. So it's both. Interesting. Let's look at the financial statements. What does it look like when it's both? Take a look. Here is Amazon's income statement. Product sales. When you buy the finger puppets. That's in there somewhere. And then they have services. They've got it broken down into 2 separate revenue items. Interesting. Here's cost of goods sold. But I don't see gross profit or gross margin. That's okay. There's not a law that says the company has to put that number in the financial statements, especially if they have products and services. If you look at Walmart, they don't have cost of goods sold because their first revenue item is products and the second one is membership fees. All right? And so you won't always see gross profit or gross margin. But one thing I want to point out here, it's kind of interesting. If you didn't know that Amazon had a cloud computing business, you might be surprised to learn that Amazon is basically a cloud computing business with a retail arm stuck to it. Your idea of Amazon might need to be flipped around. Look at the numbers here. $242 billion in product sales in 2022. Look at services, $271 billion. They sell more now in services than they do in products. Moreover, look at the cost of goods sold here. Yeah, they are losing money when you count fulfillment, cost of goods sold on product sales. And so literally, it's quite literally a computing business with a retail arm stuck to it that is draining money out of it. They're not making money on the product side of the business. I am putting on my predicting hat. I'm looking into my crystal ball. Sometime, I would say, I can't say when, maybe 10, 20 years down the road, you will see Amazon split into 2 different businesses. The product side will become so unprofitable that they will split it off. I think you'll see that at some point. Balance sheet time. Well, look here. They've got the inventories right there. Very similar to like we saw with Lowe's. And so they're kind of straddling that fine line between retail, service. The financial statements are kind of showing elements of both there, aren't they? When they got the service sales right there, you got the inventory on the balance sheet. All right. One last thing to do here. I mentioned gross profit, gross margin, how it's a hugely important number. It's worth it to take some time to practice calculating it. It's always going to be sales minus cost of goods sold. Selling, general administrative expenses are not going to be included in this calculation. We don't care about those right now. We're putting any management, marketing, accounting, selling cost, all that stuff, leave it alone for now. It's just net sales minus cost of goods sold. Okay? And sales could be credit sales. They could be cash sales. We add them together. Total sales, back out the returns. Minus cost of goods sold. So I've got the numbers there for you. These are taken from 2022 financial statements. All the numbers are in millions. If you want to take a moment to calculate the gross profit for each one of these companies, you can go ahead and practice that. I'll pause the video. We'll come back and check our answers, and then we'll call it a video here. All right. Hopefully you had a chance to make your calculations there. We'll throw the answers in there. Gross profit, the amount of profit that we made just selling the product. Net sales minus cost of goods sold equals gross profit. Big number for a retailer, big number for a manufacturer, non-existent number for a service business, right? That wraps up our video right now. As always, if you have any questions about your homework or anything that we talked about in the lecture video, heck, even anything that you read in the book, assuming you're reading the book, which I hope you are, feel free to reach out. You have my contact information. As always, I'd be happy to help. In our next video, we're going to do a little bit of accounting, talking about how to account for it when that retail business buys inventory and throws it on the shelf. How do we do the journal entries for that? Exciting times ahead. I hope to see you back here for all of them. Until next time, take care, everybody.